as Tom Lee and about 98% of other fund managers on Wall Street believe markets will continue to do well over the next 12 to 24 months, there is a massive day of reckoning coming for markets soon. But on the bright side, this will lead to a multi-year or multi-decade broad market bull market, not just a 7-stock bull market. And this could turn out to be the biggest and best wealth creation in the fastest amount of time that you have ever seen in your entire life. I have the secret and I will tell you all about it in this video. First up, there's 2 different ways the day of reckoning will come for our markets. The worst case scenario is if they both happen around the same time as each other. That would be really bad. Number 1 is the Fed makes an error, pushes this economy too close to a recession, starts cutting rates, and stokes panic. At this point, we're already headed down that trajectory as is. On average, the S&P 500 falls 23% over the course of about 200 days upon the first Fed rate cut. That is, if the Fed is cutting into weakness in the economy. And if you think all rate cuts are equal, then you want to hear this. And if you don't take my word for it, then you definitely want to hear this.
Interesting. The idea if they do cut, it's going to be bad. It's not going to be for the right reasons because inflation's coming down. It's going to be for the wrong reason. And right now they don't need to do anything. The economy is in good standing. What do you make? What do you make of that?
Well, I think the Fed does want to cut rates. I know as the investment community, we would like to see them, but I agree with Keith's point. And what we shouldn't maybe be asking isn't when they cut rates, it should be why they cut rates. So if we look at a situation where they're cutting rates because we went into a recession, that's problematic. They can throw as many rate cuts at us as they want. It's not going to save anything. So this is a very thin needle that they've got to thread. I do think they're going to cut rates one time at the end of this year, but in the longer term, whether it's November, October, December, February, it doesn't really matter. It's affecting short-term trading.
Not all rate cuts are equal, and it's more important why the Fed is cutting rates than when they cut rates. I think Wall Street has been so focused on when do they cut rates and not as much focused on why are they going to be cutting rates. As the unemployment rate has went from 3.4% to 4%, the Fed looks dead set on causing economic instability and weakness before they start cutting rates. The Fed made that about as clear as they ever do last week, when the Fed's dot plot showed less rate cuts for 2024, even though the economy is weakening. I think a lot of people forgot what Jerome Powell said in 2022. Jerome Powell said, and let me paraphrase here, we don't care about the economy. We need to get inflation under control. If weakness comes in the economy, then that's the cost of doing business. And that was a severe paraphrase, but long story short, the Fed will sacrifice the economy and a recession in order to get inflation down and keep inflation down. And let's even be honest, historically, you need a recession to bring inflation down. So I think that is a major problem for markets. So that's a problem. The Fed is waiting for perhaps a negative non-farm payroll report, maybe the unemployment rate to hit 4.3, 4.4, 4.5%, or overall GDP to start contracting before they actually start cutting rates. After all, the Fed is the reason inflation is still high in areas like housing, which is really a topic for another video. So the Fed trying to solve the problem is actually making it worse. I would say the odds of a Fed error, the Fed slowing the economy too much before they start cutting rates, is probably like 80% at this point. And I know some people were like, hey, if the economy slows more than expected, the Fed's gonna cut more than we expect, and that's great. And as we showed in that clip, that's just not true. Quote, it doesn't matter how many cuts the Fed throws at us. It's not gonna matter if we go into recession. And with a lot of your data recently, it's been in the wrong direction. A lot of your economic indicators are pointing down, even including retail sales that we just got last week. So all of this is the first potential scenario, the Fed error that leads to a crash in markets, which At this point, I have no faith left in the Fed that they are going to cut rates at the right time. I think they already should have started cutting rates if they were truly trying to avoid a recession. But hey, I'm subject to be wrong, and maybe the economy is just fantastic and everyone's doing well. But from what I see, what I hear, and what the data says, that's not true. People are suffering. The second catalyst that could give us a day of reckoning in the markets, fancy way of saying a crash in the markets, is AI. Now, I know a lot of people don't want to come to terms with AI as a possible market downside catalyst because we've seen so much upside in broader indexes from AI. But let me run you through what's going on right now. NVIDIA, SMCI, Dell, Microsoft, Google, all of these companies are priced as if they're going to start seeing results from AI within the next 1 to 2 quarters, not 1 to 2 years or 5, 10 years. You're not priced for that. So the markets want to start seeing results from AI. If that does not happen, markets will start to demand these companies pull back on some of their AI investments, especially at the same time as the economy weakens. That becomes very problematic. But again, if you don't take my word for it, maybe you'll take someone on Wall Street's word for it.
You're excited about things that are other than just the big five. I guess some people are questioning whether the concentration risk and outperformance is healthy for the overall market.
Well, healthy is sort of a pejorative term, but I would say it would be better if there was wider breadth in terms of the performance in the market. There's lots of opportunities in the market in terms of performance, and we talk about that every day. Some of the GLP-1 drugs. The real story that everyone's discussing, all the questions that come to us relate to AI. And we think about AI in a couple of phases. NVIDIA, big winner, obviously. With the infrastructure build-out companies, yes, some of the hyperscaler companies, some of the semiconductors clearly benefiting. ARM, TSMC, kind of other aspects of the infrastructure build-out. And there's been much more skepticism around the sort of enabler, the revenue companies that will, the benefits of widespread adoption of AI. And the question, Carl, is about what is the return on investment of all those AI dollars. And that, I think, is a big question. It remains to be answered, but you'll start to see that in the next couple of quarters. If there's not some evidence that there's a return on this money, then I think a lot of investors will start to ask, is there a real story there?
This guy just put out a 5,600 price target on the SPY. This guy is Goldman Sachs head of equity strategy. So he's like the top guy for stocks at Goldman Sachs. And I know a lot of people push back on the narrative that this AI boom is a bubble. And I think on face value, that's correct. AI is not a bubble in the longer term sense, just like the internet bubble wasn't a bubble in the longer term sense. But I do think we have a bit of a bubble as far as expectations. For all of the investments that have been made in AI, it's gonna take many, many years for that ROI, return on investments, to actually start showing up in any kind of meaningful way for any company. Besides NVIDIA, who else is making a product that is profitable or even bringing in revenue for that matter? There was actually an interesting report done on Microsoft that is spending billions of dollars on their Copilot AI and other endeavors, and they're bringing in only a handful of millions of dollars. It's a massive money-losing business at this point. So that's just it. Markets have these wild expectations that everyone's going to gravitate to AI and these products are going to be massively successful in the near term, and that's not what is happening. That's not what is going to happen. If you look at Salesforce, C3 AI, you look at some of these data providers of AI, they actually did bad last quarter. Salesforce had their first miss since 2007. So with expectations this high at Microsoft, at NVIDIA, SMCI, Dell, Google, Amazon, that AI is going to be this next driver of growth, that's not true in the near term. And I think we can all agree on that. But again, when markets are priced for that, we're going to be in for a big disappointment. If stocks start to get pummeled on earnings, if there starts to be disappointment due to all of this AI investment and not seeing any results, these companies will start pulling back their AI investments to some capacity, and that could end up being a problem for Nvidia itself. And don't get me wrong, I'm exposed to AI. I am fully invested in this market. I have no financial incentive to say this. And I'm an uber bull on AI. I think AI is going to be a main central part of all of our lives 10, 20 years from now. But not next year, or the year after, or the year after that. Well, maybe like 2.5, 3 years from now, it may start to be more obvious. There may start to be different products that are catching mainstream attention at that point. But still, it's going to be very hard, if not impossible, I would argue outright impossible, to live up to these expectations of return on investment from all of this investment into Nvidia products. Now, the worst possible scenario for the markets is this. Let's say the Fed continues to hold steady and they don't adjust their interest rate policy. They continue to play this whole data dependent role. The economy weakens. The Fed's forced to cut rates. I think that is a base case scenario at this point. That alone gets you a 20+% crash, historically speaking. But add on top of that, the AI expectations, well, going down big time. And essentially the near-term AI bubble popping. That would be a disaster for the markets, and I would argue could lead to 50+% downside from here. And just for a little bit of context, 50% downside from here would lead you back to about the lows of the triple Qs during 2022. So you'd really give up the last 2 years of gains. Now, is this a base case scenario? Obviously not. But it's a possibility that nobody is even considering. Because imagine it like this. Well, all of Wall Street says Nvidia's cheap, trading at 35 times earnings. Well, that's if Nvidia can meet the lofty expectations, and presumably the companies that are buying Nvidia GPUs start building products and start seeing a return on that investment. If those companies do not see a return on that investment, investments into Nvidia GPUs will slow down, if not outright stop for a period of time. And then the markets expecting, 20+% growth for next year, you could actually see 25% negative growth next year. Now, all of a sudden, Nvidia's multiple is double what it is today. Again, the markets are not expecting that, so this could be a bubble of mixed false expectations. Kind of like the cannabis bubble in 2017, 2018. If you were investing in the markets during that time, cannabis stocks went buck wild crazy because it was presumed that cannabis would become legal and these companies had the first mover advantage and they were going to become these mass market players in a multi-billion-dollar global industry. Even if that is not wrong and those companies do well over time, those stocks are way off of their all-time highs. Now, again, I don't want to necessarily compare AI to cannabis because we're in totally different playing fields of total addressable markets and potential value creation, but it's sort of like the same logic. Those companies had lofty expectations, were unable to meet them, and their stocks fell big time. And I do think this is a real risk with AI stocks today. Is any of this guaranteed to happen? Obviously not. But I could envision a scenario where, again, the economy weakens, companies are not seeing a return on their investments, and the markets kind of force those companies to dial back their investments to preserve their own profitability, especially as the economy weakens. That's going to likely be what they try to do. And you could have a scenario where Nvidia's numbers are not nearly as good the end of this year or next year as markets are currently expecting. That's problematic, but at the same time, we could be getting close to a recession, going into a recession, as the Fed is just too late to start cutting rates. So again, I think both of these things happening at the same time would be an utter shit show for markets. But either one of these things happening separately would also be problematic. If the Fed does engineer this soft landing and they start cutting rates in time, the economy holds up, but companies stop investing as much in AI, that's a big problem for markets as well. Or on the contrary, if somehow the economy weakens into a recession, but AI investments continue to run strong and they start to see a return on investment from companies, buying these GPUs, the products come out and things start to do better than they are today, then that's also a problem because now you're in a recession. But unfortunately, I think the two may go hand in hand. As the economy weakens, I think AI investments may slow down. Thus, I think this worst case scenario is not too improbable. Now, what would be my potential timeline for this? Well, the next jobs report is on July 5th. The next CPI report is around July 11th. That will be important. That could set us up for a more dovish or hawkish Fed coming July 31st, the next Fed meeting about 6 weeks from now. Now, a potential timeline on this beyond just the month of July is hard to say. I think your non-farms, your unemployment rates, the BLS reports are going to be important when they come out. Inflation reports will continue to be important. I do believe inflation will continue to fall as the economy weakens. That's usually what happens. Beyond that, your GDP reports will also be important. So if I were to put a timeline on this, I would say the middle of July, about a month from now, until the end of this year is when you really want to be watching for a potential weakening in the markets. And I think, like Goldman Sachs chief equity strategist says, within the next 1 to 2 quarters, which is in that time frame, if companies don't start putting up AI results, then the markets might demand less AI investments. The bright side to all of this that is truly exciting is once you get this flush out of the Fed's error, of the AI expectations that come down, you will see a broad market, bull market for many years, if not decades to come. Because what's going to happen when AI disappoints, when the Fed makes an error, is the Fed's going to cut rates probably down close to zero again. The markets are going to look around, investors I should say, and they're going to go, wow, we've defeated inflation, rates are low like they used to be, growth can do well, there's a lot of immigration, there's going to be continued growth and investments into America, especially with domestication becoming less dependent on China and other markets. There's going to be a very strong bull thesis to be invested in US stocks. Now, keep in mind, you're already trading at subpar multiples in small caps and mid cap stocks. And I'm sure those areas would also fall when the Fed makes an error and AI disappoints. You're going to see more pain in those sectors and call it your average stocks. That's going to set you up with a massive wealth creating buy the dip opportunity. Like if you beat yourself up for not buying pandemic stocks at the lows and instantly making, 3x to 10x on your money within a month or two, if you were beating yourself up then, I think this is going to be a similar, if not better opportunity. Because again, the markets are going to look around and they're going to say, this is a great time to be invested. So yes, a day of reckoning is coming. And I know if you're in AI stocks, if you're in big tech, you're probably not going to like that. Really, anyone, you're probably not going to like that because it means losing money in the short term. But it is going to set you up for true generational wealth creation. If you take advantage of this information, if you start loading up on as much cash as you possibly can, and you get ready for this now. Because remember, recessions create more millionaires than lottery winners by over 10x. But you have to have money available during a recession to take advantage of it. So that is going to conclude this video. Let me know your thoughts on all of this down below in the comment section. Are you ready? What are you doing to prepare? Do you think we're going to get any downside in our markets? I know this is such a contrarian call. It's going to be hard for people to wrap their minds around, but just think about it. It starts to make a lot of sense. So I would love your thoughts in the comment section. Hit the like button, subscribe to the channel. You guys have a fantastic rest of your day. I will see you in the next one.